Hey everyone, how's it going? My name is Ihan Isaacs. I'm the head of global growth for the Founder Institute. Thank you so much for attending today. We have people joining in from all over the world, Pacific morning, Eastern afternoon, or early afternoon, evening in Europe, nighttime in Asia. I'm based in Dubai, UAE. Super glad to be here. I think this is our sixth or seventh Venture Trailblazers. So super excited for today. We have an amazing speaker lined up. I'm going to introduce Mike here from the VC Lab team shortly. He's going to give a more in-depth intro. Before we kick things off, I just want to go over some housekeeping items. So this platform is known as AirMeet. Some of you may have experienced it before, some of you have not. It's ideal for a desktop or tablet. It's not super ideal when you're on mobile. So I don't think you have all the functionality on mobile. Very briefly on the right, you have a chat icon. Use that to chat with everyone and see how everything is. Underneath the chat, there's a Q&A. So please, if you have questions for Mike and James, throw that in there. Our team's going to be monitoring it, feeding it back to the speakers. And at the bottom of the screen, you'll see some emojis. So if you like what the speakers are saying, give them a thumbs up, heart, party hat, whichever it is. That being said, just a very high level thing on Venture Trailblazers. Venture Trailblazers is by FI and VC Lab, was brought together to bring together the different communities and the venture startup mentors, our alumni, everyone together, anyone related to startup, and just educate and create the space for a lot of different individuals. And also, after this event, we're going to leave the networking tables open. Feel free to communicate with each other and talk with one another. We had about 1,000 people register. We're at 200 people live. We expect, to get to about 300, 350. So that there'll be ample amount of opportunity to meet everyone across different ecosystems around the world and across the FI group and the VC Lab group. With that being said, I'm going to bring up Mike. I'll let Heel will be your main host for the evening. I guess let's say Mike, whenever you're ready. Perfect.
Hi, everybody. Welcome to Venture Trailblazers. It's really good to see everybody here. Thank you all for the emojis. It's amazing. Keep those emojis up especially as I introduce our guest, James Currier, here in a second. If this is your first time joining Venture Trailblazers, as Ayan mentioned, this is a joint event with the VC Lab community, the Founder Institute community, to try to help you kind of better understand the startup ecosystem, venture capital, and everything together. For those of you that don't know me, my name is Mike Supervici. I'm the head of acceleration at Desal Group. Desal Group is a company whose entire purpose is to help emerging managers thrive. Okay, we do this through a variety of different initiatives. One is our VC Lab Venture Capital Accelerator that's designed to help people launch enduring venture capital firms. We have a product called Desal Hub, which has become more or less the operating system for emerging managers that are starting firms. We have a back office offering, we have a fund of funds, we have a whole bunch of things that are basically designed to sort of clear the way for new and emerging managers to help fund the future of startups. And that's because most of the problems that are happening today are generally going to be solved by startups, and we want to make sure that more and more startups have access to capital. In this Venture Trailblazer series, we try to feature people that have been pioneers, innovators in the space. Hence the point, Venture Trailblazers. And today, talk about trailblazers. Let me introduce everybody to James Currier. James Currier is the founding partner of NFX. It's a venture capital firm with over $450 million under management. James himself is a just amazing serial entrepreneur, has started 5 companies. He's also angel invested in a whole bunch of groundbreaking companies such as DoorDash, Lyft, Patreon. I mean, the list goes on and on. He's also helped 10 companies achieve more than 10 million users. And we're going to talk a lot about networks, network effects, and things like that with James, because that's an area that he's an expert in. And I'm super looking forward to the conversation. So everybody, please welcome James to the stage. And James, if you can also maybe sort of introduce yourself to the audience, we would also really, really appreciate it.
Sure. So I'm a kid who grew up in the Boston area in the United States, and got scholarships to places like Exeter and Princeton and Harvard Business School, and then ended up in the tech world in the 90s just fascinated with software. And so I started 4 venture-backed companies. The first one was called Tickle. It was one of the first A/B testing, viral, user-generated content companies. And then we did a gaming company, and then we did a growth analytics software business, and then we did an enterprise healthcare software business, all of which did well. And so then we did 50 angel investments, and then in 2015 started an accelerator. We invested in 80 companies over 2.5 years in that format, and then flipped over NFX to becoming a venture firm in 2017, where we raised 150 million fund, and then a 325, and then a 450, and now another 325 we haven't announced yet. So we got about 1.6 billion under management now, and we've made about 190 investments with the venture capital group, and so yeah, I've got 4 kids and live in Palo Alto.
Amazing. So can you maybe tell us a little bit more about NFX, and if you can sort of go into network effects as well as part of that narrative, that would also be really good to kind of sort of.
Sure. So NFX stands for network effects. And we became fascinated with network effects in 2004 when we had a company that did not have network effects that sold to a company with network effects. And our company had much better technology and much better people, but they were worth a lot more than we were. And we realized it was because they had grabbed a network effect. And so we became students at that moment of what these things were. And by sort of 2010 or 11, we probably knew more about it than anybody else in the world. And so we decided to call our accelerator and our venture fund NFX, because those were the types of businesses that we were looking for as investors, as angel investors, that we were really excited to invest in. And so, we are a seed fund where we'll put in anywhere from $2 to $3 million to lead a seed round. We meet every week with the founders after that. We're very involved. We don't take salaries. We're doing this for sport. My co-founders, Pete Flint, who founded Trulia, and my other co-founder, Gigi Levy-Weiss, who's in Israel, who founded Playtika and was the CEO of 888. And the 3 of us together have built and sold over 10 companies that were worth over $10 billion cumulatively. So, which was twice as much as Andreessen and Horowitz when they started that firm. So we have a lot of operation experience, and we're doing this for sport. We're doing this to create a legacy firm, and instead of investing at the A and the B with a multi-billion-dollar fund, we're investing at the seed with sort of a $300 to $400 million funds. And we've got a team of 45 people. We do a lot of support. We help the founders with PR and with recruiting and with fundraising and all the things, deck design, all the things that the early stage founders need to clear off the deck so that they can focus on product and customers. And we got offices in Israel, Palo Alto, and San Francisco.
Incredible. So why are network effects so important?
So if you want to create a company of value, both for the world and for yourself, and for your investors, you need to have defensibility. And in a digital age, there's only a few defensibilities. It's brand, scale, network effects, and embedding, what we call embedding. And network effects is the greatest of these 4, because they're available to startups, and because once they get going, it's very hard to beat you. And so you have defensibility because of those 2 things. So embedding is something like Oracle, where they embed their software into your enterprise. And if you try to rip them out, it would be very, very painful. So they can just charge you 20% more next year, 25% more next year. You can't do anything about it. That defensibility is available to startups, but scale and branding aren't really. So we focus on those 2 types of defensibilities when looking at companies. And we encourage our founders to develop more embedding, develop more network effects. And on nfx.com, we've actually published the network effects manual, showing you the 17 different network effects that are out there that you can use. They're sort of like colors like you might use to paint a painting. And you can use the different colors to reinforce each other as you build your product and as you build your business. And once you get a network effect or 2 or 3 reinforcing, it's very hard for someone to beat you, and you end up taking 60% of the market or more. And that's what creates really defensible and valuable businesses. And if you think about any company you might admire that you think has created a tremendous amount of value, whether it's Amazon or whether it's Facebook or whether it's Twitter or Google or Intuit, they all have network effects. And we didn't realize that in 2004, but 20 years later we do. And we've actually published, we have a masterclass on nfx.com. If you go up to the nav bar, you'll see masterclass, and there's a 3-hour video that explains all this in a very consumable way. And the reason we do that is because we want more founders to come to us with network effects designed into their businesses. In fact, we've looked at all the applications we get for capital, or the companies we look at. And while 70% of all the value created in tech in the last 30 years has come from businesses with network effects at their core, listen to that, it's about 72% of all the value created in tech in the last 30 years has been with companies with network effects at their core. Less than 20% of the business plans have network effects designed in. So by publishing this, we're encouraging founders to come up with businesses that have network effects, because we think it's in your best interest to do that. And then those are companies that we can invest in.
Well, speaking of that, when you look at an investment with network effects, what are some things that get you excited? Like, what do you look for in general when you see a company like this?
Well, the basic idea of a network effect is that the more users you have of the product, the more valuable that product is to all the users, right? So if you're the only person on Twitter, it's not very interesting. But if there's 10 people on Twitter and you know them, then it's starting to get interesting. You get their updates. But if there's millions of people on Twitter, then there's a lot of value. And so Elon had to spend $45 billion to buy it because he can't replicate it. It can't be replicated. So many people tried different, I think Facebook even tried Threads to be a Twitter killer. It's gone nowhere. So that's what gets us excited, is when nodes, people or companies or something, nodes are attaching to a network that then adds value to the other network. So you can have a marketplace network effect where, let's say on eBay or Craigslist or Monster.com, you have the employers and the employees, you have the buyers and the sellers. These are marketplace network effects, and those nodes are attaching to that central business that you can own. And if you get everybody attached there and you get liquidity, it's going to be very hard for someone else to replicate that. Liquidity just means, can a transaction take place? So by looking at each of these types of network effects and seeing them in the businesses that are coming to us, that's really what gets us excited. And particularly finding founders who can think in that way. Because you can't just do it once. You can't just do it once and then live off it. You have to do it. If you're doing a marketplace, there's many seasons of managing your marketplace, and you have to constantly be reinventing that network effect. And then once you get that network effect, you want to start adding more onto it. And then you end up with your very big company. So that's what we're looking for. We're just looking for companies that have a trajectory to be very big. For us, we want to invest in you and have you exit, go public for, $2 billion, not even $1 billion anymore, but like literally we want you to be big because that's what moves the needle for our fund. And we think that's what's fun. It's going to take 100% of your time, whether you start a bakery, which is not scalable and has no network effects, or whether you start eBay. You're going to be spending 100% of your time running this company. You might as well run something that can be big.
You mentioned founders, and there's a lot of founders on this call here. And you said about them having some sort of like network effect or thinking about network effects. Any other sort of qualities that you have determined or have seen as throughout all of this investment experience that you've had, that some common qualities that a lot of other founders share?
Yeah, I mean, look, I think now's the time to realize that we live in the age of the startup industrial complex, where things like VC Lab and NFX exist. We are feeding you information. We're putting it on your plate. We're making it easy for you. This was not the case 30 years ago. The only people who were founders and entrepreneurs 30 years ago had to be founders. It wasn't high status. It was a lonely job. People were physically misshapen. They were autistic. They were just weird people. And I was there. I was an associate at a venture firm 30 years ago. And the people who came in the door were just tough as nails. Most of them already had a $3 million business that they had built on their own credit cards. There was no blogosphere to read about how to do a startup. There was no venture capital. There was only 40 venture capital firms in the United States, 150 venture investors. Now there's over 30,000 venture investors worldwide. So we live in an age of the startup industrial complex, which has drawn in a lot of founders who maybe shouldn't be founders, because it's a very hard job. There's a lot of suffering. There's a lot of sleepless nights, a lot of mistakes. You're firing your co-founders. You're losing your biggest customer. You're having an investor back out at the last second. You're missing payroll. You're going off salary. There's a lot of challenges typically with building a startup, and most people think that it's like a career choice. It's not. It's actually sort of a whole mental way of living. It's a whole way of living. It's not just a career choice. And so, what most great founders have in common is that they're a bit insane. They're a bit crazy, and they are relentless, and they're aggressive, and they're fast. We call them sauvage or savage, right? We call them savage. We're looking for savagery. You have to move incredibly quickly. We had one guy who grew his company to 250. He narrowed it down to 30. He grew it back up to 120. He narrowed it down to 40. Like, it was just violent for years and years because of COVID and losing 95% of his revenue and da, 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 da. But the guy was savage. And so he survived, and now he has a $60 million profitable business, and he's going to double and triple over the next few years and hopefully go public in the next 3 or 4 years. But it's been brutal. He lost his fiance. He had to live in different countries for 6 months at a time, 8 months at a time, while he was trying to raise capital because he couldn't find capital. And it was brutal. He spent his late 20s and early 30s doing this, and he had nothing other than this. And I think most founders are deluded right now into thinking that it's a career choice, that you just kind of do a startup. Well, it's just a choice I make. No, it's you have to be savage.
Yeah, it's pretty hardcore for sure, especially being obviously on the other side, and you've been on the other side plenty of times. It's in general. Speaking of the industrial complex, you mentioned that you're doing a lot of tools and things like this. You do so much stuff, and you're giving away for free. What is NFX Signal? Why are you doing it? How does it work?
Sure. So, I'm a software designer and a foundation, and then I became a CEO, and now I'm a VC. So that's my trajectory. And so I like to keep building software. And so, there are certain tools that we wanted the ecosystem to have for the founders and other VCs to have. And one of the things we built is called Signal, signal.nfx.com. This was before the Signal messaging app blew up. So this was 7-8 years ago we started this thing. And now this is where VCs build their profile. So your investing profile lives on Signal. Your career profile lives on LinkedIn. Your investing profile lives on Signal. And we started with 1,400 of the top VCs here in Silicon Valley. And now there's over 31,000 people who have built profiles there. We can, you can see who you're investing with, and other founders can find you there. And so this is where great founders go to find their investors. And I encourage all you aspiring VCs and VCs to make sure you create your profile there, and be found, and indicate which sectors you like and stages you like, and who you're investing with and the investments you've made. And it's a really good way for founders to find you when they're looking for good capital. Another tool that we built is called BriefLink. It's basically a DocSend specifically for startups, because DocSend allows you to send the PowerPoint if you're a founder, send that in an email link to an investor. But it also asks you 12 questions, which a VC typically asks in the first meeting, and then it also asks you to put up a video. And so that combination, that BriefLink, allows the VC really to have a first meeting in 3 or 4 minutes, because you get the answers to all the questions you're going to ask. You get a sense of the founder and how they speak and who they are, and you get the whole deck. And so it's a very efficient way for founders to raise capital, because then they don't have to take too many first meetings. The first meeting they do take after sending a BriefLink to you is going to be a second meeting. It's going to be much more productive. And you as an investor like the BriefLink, because then you can get through the first meeting in 3 or 4 minutes instead of a half an hour. It's very time efficient for you. And so we have we have hundreds and hundreds of companies per month that are using that to raise their capital. And over $5 billion has been raised by the companies using the BriefLink. So it seems to work. And these are 2 public tools that we have available for folks, and we're going to continue to build more public tools to help the whole ecosystem thrive. We can only invest in about 0.3% of the companies we see, And so we hope that these tools help founders when we can't invest.
What an incredible service to the community. Thank you so much for doing this. I'm sure a lot of founders will continue to benefit from this stuff moving forward. If you're, whatever you feel comfortable sharing here, we do have quite a lot of VCs, especially VCs that are starting their firms, Fund 1, Fund 2, Fund 3 on a call like this. Anything you feel comfortable sharing about some of your internal tools or processes and things that you've sort of developed to kind of make sure that you kind of let the top sort of companies bubble up so you can make an investment?
Yes. So we look at 8,000 companies a year, and we think in the next 2 years, we'll be looking at about 15,000 companies per year. And in order to do that with 5 partners, the only way to do that is with software. And so we have an internal team of 16 people who are working on data management and working on software development for both our internal and our external tools. We've had that for 7 years. We actually hired our head of product 5 months before we started the firm because we're so committed to building software. And so we save an enormous amount of time doing that. I know that, and increasingly we're just adding more and more AI to every aspect of the sourcing, analyzing, deciding, winning, and supporting aspects of the venture process. And it's a big initiative for us and has been. I know that you guys provide a software suite to everybody with Decile, which I think every VC needs to have really good software to help with all the data management and the process management.
You and I were just talking about this, that when you first started, there's maybe, 150, whatever number of VCs. It was pretty hardcore. Now there's like 31,000 profiles just on NFX alone. So who knows, there might be more. Love to get your views on sort of the arc, right, of how we got here, and where do you think the future is now? That there's this many VCs, the way that the approach that you have to take in sort of sourcing, my guess is probably has to change. I'd love to sort of get your views and insights on this.
Yeah. So essentially, the venture community in 1994, when I was an associate at Battery Ventures in Boston, was 150 general partners across 40 firms that were active. We had a $42 million fund, and we were one of the most active venture capital firms in the United States. And there was 75 associates, 150 GPs and 75 associates. That was the whole community in the United States. And there was maybe 2 law firms in Boston and 3 in San Francisco who even knew how to manage the documents for doing private equity investments in these tech companies. Like, what were the vesting schedules for the founders, and what did clawback mean, and yada yada yada. All these terms were very tightly held by basically 5 law firms in the United States. Starting in 1994, coincidentally the year that I joined, when we got the internet, we entered the age of software. And software made it so much easier to build high-scaling tech companies using the browser and TCP/IP and all the standards that have been adopted, that there was a flourishing of opportunity for founders, which they filled in. Then they started to need more venture capital. These venture firms and these law firms got overwhelmed with what was happening. And so more venture firms were starting to be funded. And we also needed, remember, to not only do software, but we needed to do telecoms data infrastructure. So we had to build out the internet. There was a lot of switches and a lot of fiber optics and a lot of that, mobile telephone switching network. I mean, there was a lot of telecom infrastructure that needed to be built during the 90s. And it was a huge thrust of many of the investors, called datacom or hot boxes in many cases. And by the end of the 90s, we had about 600 GPs, general partners in the United States. And then the crash came of 2000. And then things sort of started to pick back up in 2003, 2004. And that's when the startup industrial complex really started, where by the end of 2013, we had 6,500 general partners. And we had, tens of thousands of startups, all flourishing in the consumer internet and more in the B2B internet and software space. And by the end of that was by the end of 2013. And then, fast forward to today, we've got 31,000. And my bet is that, we will have 60,000 VCs in the next 6 years. I think we're going to go from 30 to about 60,000 people around the world. And the reason is twofold. Number one, the diffusion of knowledge about how to do tech, the diffusion of knowledge about how to do VC is accelerating. From those 5 law firms and those 40 little venture firms who did no PR and didn't talk about what they did, it's now accelerated. Another reason is that the surface area of technology has grown. So now we're getting into robotics, we're getting into climate, we're getting into bio, we're getting into space, not just software. There's so many new technology areas, agriculture, so many new technology areas that need startups, that we're lucky that we already have 31,000 VCs, because we need 60 in order to cover the surface area of all the technologies that need to be invested in, all the problems that we can solve using technology over the next 30 or 40 years. And I think that more and more people are learning how to, and realizing that they are capable and tough enough to be startup founders. And so I think it's just going to grow from here. And I think that limited partners, by the way, people with these piles of capital, 90% of limited partners still have no venture capital investment. And they're just learning about the asset class. And, it's only a $200 billion a year asset class. One hedge fund is $200 billion. One hedge fund can be $200 billion. The whole asset class for venture capital is still only $200 billion a year. So for us to grow that to $400 billion and double it from 30,000 VCs to 60,000, it's not that hard to do. As long as enough of these LPs take 2 or 3% of their overall capital and allocate it into our asset class, we're going to hit that no problem in the next 10 or 15 years. So that's where I think it goes. I think the world needs it, and there's a lot of opportunity in a lot more surface areas for us to look at.
Well, it's going so global too, right, James? I mean,
That's right.
there's
That's
people.
right. That's the last thing to mention is that the diffusion of knowledge has left just Boston and San Francisco, it's going around the world, and so everyone's going to get involved for sure.
Everyone, add your questions to the Q&A. We're doing this for you. I do see quite a lot are starting to come in, so I definitely want to start giving some of these questions over to James. Really quick though, for the GPs in the audience, James, that are sort of kind of like getting started right now, how do you think about sourcing, for this sort of next generation of GP? I mean, historically, when you only have so limited amount of like firms, you can kind of sit back a lot of times and just get a bunch of intros and like not have to be as aggressive in sourcing. I don't know, with this kind of volume, it feels like it's going to definitely shift. This is at least my personal view, but I'd love to get your views on it too.
Yeah, absolutely. I mean, when I was an associate at Battery, even in 1994, I was smiling and dialing. That was my job. I was 24 years old, and they wanted me on the phones calling up founders. I would read paper-based, newsletters and paper-based magazines and niche little, mobile switch, magazines. And then I'd read the Wall Street Journal and read Forbes. And anytime they mentioned a tech company, I would track them down using 411. I would dial up the operator in Virginia or whatever, and I would track down the company. I would call them up and I would try to talk to them. That was my job. I sat there with a headphone on, sourcing deals for the partners. Even in 94, it was an aggressive type of emotion to find these companies. And I would enter them into the database, and then I'd get credit for entering them into the database. And we built our own CRM. A guy named Ollie Kerm was a partner I worked for, and he designed and built a CRM back in 1990 that the firm used by the time I got there in 94. It was on Microsoft. It was on Apple. Anyway, so yeah, no, I think that's only getting more competitive. It's only getting more competitive to find the deals first, and then approach the founders, and then it's getting more competitive to win the deals, because the founders are going to have a lot of choice between who's investing in them in many cases. And what's interesting is that someone says, well, the best companies always have lots of choice, and I'm like, well, a lot of the companies who have a lot of choice don't end up being the best companies, and a lot of the companies that end up being best didn't have a lot of venture capital choice at the beginning, because the market's really inefficient, because there's still a lot of randomness in what companies end up working and why. And so that inefficiency, that randomness, is actually the place where there's profit to be made for venture firms. And so it's going to continue to be a data game. It's going to be a speed game. It's going to be a branding game. It's going to be an aggressive sourcing game. It's like any business. It's going to get harder. And I think the VC job was, I wouldn't call it easy back in the 90s and the 2000s, but it was certainly easier. And going forward, it's more of a blood sport, and it's great because the VCs now have to behave well. And one thing I'll say is that, and this is my opinion, but the further you get from Silicon Valley, the nastier the VCs are, and that's because there's less competition. But there's so much competition in Silicon Valley that everybody here who's still around has had to be pretty founder friendly. And if you're not founder friendly, very quickly the founders find out, and you do not have an option to invest in the good companies anymore. But as you get further away, you have a different mindset. I know in Europe, there's a lot of ideas that investors feel like they own the company or they can control the company from the board, or that's crazy. I mean, it kills companies, that mindset. And so the Silicon Valley mindset of founder friendly, quick service orientation, I encourage you to adopt that as you want to be successful in venture capital, because if you don't, the founders will find out really quickly. Now we have a thing called the internet, and there's places where people can talk about your behavior. And so the competition, I think, is going to make a better, faster startup industrial complex for everybody.
I mean, I can't agree more. When Adeo and I started this whole VC lab thing, that was one of the problems we were literally trying to solve. We were seeing angels, right? Trying to get on boards and do all this stuff and all over the world and things like that. It's we need professional venture capital everywhere. And yes, good behavior is critical, right? And it aligns around the success of the company as well, which is also super important, right? If you're too aggressive with that early, it just makes it much more challenging for the company.
Yeah, there's a lot of VCs who are playing business. I call it playing business, and they think that their job is to be tough, and their job is to, talk about spreadsheets and legal stuff. And these startups are barely alive, man. There's no assets to divide up. There's zero sum thinking that we get the further you get from Silicon Valley is toxic. You have to have a mindset of abundance. You have to have a mindset of, no, we're just going to build the pie bigger for everyone.
You mentioned
that mindset. It's don't play business. Don't, even in New York, it's tough. It's this mindset of the PE shops is about dividing the pie and who can get the most and who can have the sharpest elbows. Like the PE firms, the guys go to bed. If you're suffering, then they know they did a good job and they sleep well. And that's how they measure their success. It's like a mafia boss. If you suffer, they've done a good job. And that's not how a VC should be.
Well, and the results are so binary. Either these companies become wildly successful, or there's just there's no pie. There's no not one or the
yeah. So. And if you get your money back versus nothing, it really doesn't matter to your.
Yeah, that's still like a zero in venture math, basically. Yeah. I hear you. There's a question here. This is coming from a founder. You mentioned that right now, when you're looking for companies that could potentially go public, become worth billions and billions of dollars. Can you share some of the pros and cons of companies going public?
Oh yeah, I mean, you can see companies are going public later and later because the transparency is horrible. I mean, this is one of the reasons why most crypto companies fail, is because they issue a token, and that token is essentially a public voting on their stock, and that transparency is deadly. When you are building something like a startup, it's such an ugly process. So many things are broken. So many things don't work that you want to be public as late as possible. And the cost of being public in the United States is $4 million a year, just expenses, $2 to $4 million a year. It's enormous cost. Time sucked for the top management, who are your greatest resources. It's a mental switch. Changes the mentality. I always say the greatest point of leverage of any startup is the founders. And now the founders are having to think about the public stock all the time. The employees are now thinking about the stock instead of thinking about the customers and the metrics. So yeah, there's enormous cost to being public, and you're seeing fewer and fewer companies choosing to go that path, which is unfortunate. So, but eventually, a lot of these tech companies are going to have to go public, and they're going to have to learn that, and you're going to see a lot of management teams get switched out at that point because it's not a lot of fun.
There's a question about kind of marketplaces and network effects and things like that. Any advice for founders sort of trying to which side of they should build when they sort of think about maybe building like a marketplace business? Should they build a supply versus the demand side? And just any sort of kind of comments that you can give there from.
Sure. So for I'll answer the question, but in general, for questions like this, you should just go to nfx.com and go into the content area. And then you just scroll down the left side and it says marketplaces. And there's like 40 articles about marketplaces. One of them is called, the 19 ways to solve the chicken or egg problem. So which do I go after, supply or demand? How do I do that? So there's a whole article that lists all the tactics for solving that problem. And it's all written right there. There's videos, there's podcasts, there's all that. It's all right there at nfx.com. NFX.com is the second most trafficked VC website in the world after Andreessen because of the content on it. It's so deep and it's so good that this stuff gets sent around by everybody, and this is sort of the Bible for people building marketplaces. So I would encourage you to go there. So the answer generally is that you want to go after the harder side. Typically, if you're near business, if you get supply, the buyers just show up. Then focus on getting supply. If it's the opposite, if you have demand, people who want to spend money, the supply will just run to give them their supply. Then go after the demand side, and then put them in cold storage of some way with a SaaS product or any of the other ways of solving the chicken or egg problem there. But we've had a lot of founders who come to me and let's say it's a supply driven market, meaning whoever has the supply, the buyers just show up. And they keep telling me how great they're doing at building up all the demand, all the buyers. And I'm like, guys, I don't care. That's the easy side. I know you're making progress there. Of course you're making progress there. A 12-year-old could make progress there because that's the easy side. What I want to see you make progress on is the hard side. And that's the difference between a real founder and a person who's just trying to pretend.
There's a question in the chat about your views on how network effects apply to industries. First of all, do you think network effects apply to all industries, most industries, or is there like a specific type of industry where these just generally tend to work?
No, the network effects are hard to apply to things like space, where you're just building metal things and throwing them into the space. And we have 2 investments in space out of our 180 investments. 2 of them are in space, and those don't have any network effect. And then there are some businesses where you have to have a network effect. So everything in crypto is network effect. Without a network effect, there's nothing. And then there's all the other industries that are in between. I mean, most of the big companies in consumer software that are big, I would say 80% of them have network effects, 90% of them. And then, of course, 98% of all the value in consumer software has network effects. So there's a difference between the success, companies that are existing and then companies that have value. And if you look at the value, it's mostly in network effects businesses on the consumer side. Then you have B2B software, which you have less of them have, more of them are embedding rather than network effects. And then you have things like bio where, if you're going after a molecule, there's no network effects. But if you're going after a platform like a Mammoth Biosciences or a Ginkgo Bioworks, those very much have network effects, what we call platform network effects. So different industries have different amounts of network effects naturally, but that's why most of our investment skews toward the companies with the network effects.
And right now there's a really interesting kind of follow-up question to this in the chat. Obviously AI is really hot right now. It's become kind of like a thing. For founders building in the space, and maybe also just think of it, come to all the emerging managers or new funds that are being launched to kind of go after this space. I mean, how do you think about like differentiation? How do you think about building companies that are going to be around in a long time? Right now, with all the recent Apple announcements, that in itself might have put some businesses out of business, just from what I've seen at least. Love to get your views on all this.
Well, it's a big issue. Think of AI as a new technology, just like the mobile technology came along in 2008, where we had smartphones suddenly and all the capacities there. If you do some back of the envelope calculations, you'll see that companies that started with the mobile tech. So most startups that are successful have jumped on a new technology. Some people come to me and they say, well, Gen Z buys differently than Gen Alpha buys differently than Gen Z, than millennials. And so there's an opportunity for me to build this e-commerce site. That never turns into a very big business. Those sorts of thinkings, like, oh, people are getting older, baby boomers are getting older, they need to be serviced. This doesn't produce a big company. What produces a big company is a new technology. And when smartphones come along, we got Uber and we got DoorDash and we got Poshmark and we got a bunch of different companies that end up becoming worth billions and billions based on that technology. However, if you do the calculations, the software incumbents who existed before 2008, they captured about 93% of the value of mobile. And 7% was left for startup founders and VCs like myself. In the AI technology is sweeping through. It's also going to give startups an advantage in the same way that mobile did. The question is, of the billions of value created, what percentage will startups and early stage investors like us capture? And my guess is it's going to be closer to, instead of 7% in the mobile revolution, it's going to be closer to 3 or 4% with the AI revolution. The incumbents have a distribution advantage. The incumbents can adopt AI pretty quickly and are doing so. If you drive down the 101 in Silicon Valley, all the billboards are tech billboards. And now they all say things like AI first Okta, AI first Brex, AI first Oracle, whatever. So now all of the incumbents are becoming AI companies and adopting that as quickly as they can, certainly in their marketing and slower in their actual technology, but they're doing it. They're aware of it. They're not asleep at the wheel. You can't just sneak up on them. So we do have incumbents with a big advantage, but you do have to think outside the box. Now, we also have a problem, which is that a lot of founders come up with the same ideas. So about a year and a half ago, about 5 years ago, we started a AI spreadsheet looking at all the AI competitors because we were investing in AI and companies doing stuff. But when the whole thing sort of became public that AI was finally happening in a big way, we published a bunch of articles, including one where we published a market map, because we were having all these conversations with founders who said, hey, James, I've started this company. We did 0 revenue last month. This month we're doing 20,000. Next month we're doing 40. We're growing really fast. You need to invest. And I would say to them, I've talked to 20 companies in the last 3 weeks doing the exact same thing. And you're all growing that fast. I can't invest in any of you because it's not clear who's gonna break out. So they didn't believe me. They were mad at me for saying that. They're like, I don't see anyone in the market. I don't hear about anybody. You're crazy. I'm not crazy. So we just published our spreadsheet with all these tabs, and then they could see, yeah, there are 20 competitors. Yeah, there are 60 competitors. Yeah, there are 120 competitors in this exact space. They're all doing very close to the same thing. And so there's been a lot of groupthink in the startup industrial complex about what a good AI company would be. And I just encourage you all to look at that spreadsheet. I encourage you all to realize that everyone's having the same ideas and to think differently, because the incumbents are going to take a huge chunk of it. And then the startup founders are all having the same ideas. And therefore, it's going to be very impossible for you to break out. And so you have to think something completely different using AI that no one would think of and make it work in order to have it happen. And there will be founders who do that. And there will be multi-billion-dollar companies built, but you have to be more outside of the box than you think.
Fascinating, and that's like really good advice for all the emerging managers on the call too, as well, right? Like you got to also think really hard about this and make sure that this, in fact, is something that could be sustainable and become an enduring company that could potentially go public at some point, right? And so both go hand in hand. Speaking of trends and things like that, James, are there any trends that you're particularly excited about right now as we sort of kind of scale out beyond AI and other things like this?
No, I mean, I think that we are doing 25% in tech bio, so software driven biology. We are doing 25% in Israel. We continue to believe in that ecosystem. We are almost everything we touch has some form of AI. I think it's sort of irresponsible to build a tech product without AI today. We focus in on gaming and fintech um, and marketplaces and on property tech, um, and then on gaming and crypto, and along with bio. So those are the we are very much a best ideas firm. We don't we each have expertise in our technology verticals, and we have sort of U.S. 55%, Israel 25%. And then sort of 7 to 10% in Europe, 7 to 10% in LATAM. Those are the geographies we're in. Those are the sectors we're in. But we focus very much on seed. So all of our investments are sort of seed. Our average check size about 2.8 million. Average ownership about 18.25%. So that's what we're focused on.
And this is a very international audience, so obviously this is amazing that you're doing this so much work internationally. Obviously, like the U.S. is still a kind of a big part, which makes sense because it is a great ecosystem. But how do you sort of think about these other markets that you mentioned? You mentioned Europe and other things, and how do you maybe like how do you operate or source differently, if at all, in those ecosystems versus say something that you're like more comfortable in like USA?
So the sourcing is the same. It's through relationships, and it's through market maps that we do when we're investigating certain areas. We'll end up discovering a company in London or a company in Berlin or a company in Buenos Aires, and then we'll reach out to them and chat with them and see how they're thinking about what they're doing. I think that there's an enormous amount of opportunity internationally because the U.S. system is so competitive at this point that while you have some more headwinds like currency challenges or legal problems and that sort of thing in some of the other countries, it's a little more friction. And then particularly like VC investor mindsets are a big friction we find internationally. That ends up killing companies in many cases. You have this real benefit of the fact that there's much less competition from other startups in that geography, and you can design something that's very specific to that geography, which will give it an advantage and a defensibility against a U.S. company who's trying to come in later. And by taking some of the best ideas from around the world and bringing them to geography, that's sort of the lowest risk way to build a very interesting tech company. So I think there's a lot of opportunity. Are the exits at the 2 billion range? Not typically, because the markets tend to be smaller and slower moving. But you can certainly get a $400 or $800 million exit, and if the entry price is low enough, then it can be very much worth the time.
So for you, it's not as much of a sourcing issue; it's more of a diligence issue, I guess, to make sure that it can get to that level of return that you need for the fund.
That's right. That's right. It's the exits are often the challenge, and then what are all the sort of things that could kill the company, whether it's inflation or some sort of law change that takes place that we're just not aware of, and suddenly you find your business doesn't work anymore. That happens.
So, we have about, 3 minutes ish left here, and I want to be very respectful of your time, James. This has been amazing, by the way, everybody. If you've sort of enjoyed this talk, I'd love to see some emojis. I've learned a ton myself. So thank you so much for being so gracious with your time and sharing so much insights, James. Any final words of advice for the entrepreneurs on this call that are starting? Let's assume they're all sort of in the sort of pre-seed, maybe seed stage. They're international, global. They're building. They want to they're hardcore. Hopefully, any sort of advice for them as they're kind of building out their companies, and what are some things that they should be thinking about?
Yeah, I mean, like I said, you need to really steel yourself. This is not easy. Most of these things don't work. So we look at 8,000 companies a year. We'll invest in 30. and 80% of those won't be big. That's a very small number of successful companies. So you have to really steel yourself, and you have to be savage about it. You have to be relentless. You can't, once you start, you can't give up. You can't ever say die. The reason that all 5 of my startups have worked is because I always have redundancies. I never have a single point of failure, a single office, a single salesperson, a single engineer, a single customer. I never had a single point of failure in any of my companies. And so because most things go wrong, it was okay because I had a fallback and a fallback. I had plan B, I had plan C, and I had plan D. And that just takes hours and hours of work. And so that you have plan B, C, and D to move. And that will keep you from going out of business, which then keeps you in the game long enough to get lucky. And all of my successes have come through a lot of luck. But the reason that I was always successful for the last 30 years doing this is because I never went out of business, because I had plan D in place when plan A, B, and C all failed. And then I got lucky eventually. So that's how I would think about it. Look, the other thing is, take the Landmark Forum, take the Hoffman Institute, take whatever psychological seminar, get a psychology coach. It's worth the money. These startups are, I tell people, there's no corporate transformation without personal transformation. They are a journey for you. They are vehicles for your own growth and transformation. It's not about earning money. The people who think it's about earning money will be very disappointed. You have to focus on yourself and on your own personal development and your communication with your co-founders, your communication with your board, communication with your employees, to lead them, to create a context for them to build their LinkedIn, to build their career, to have, good relationships with people and feel like their lives are productive and meaningful. And that's your job, and all the weight's on your shoulders. But that's the job you're asking for. And so if you're not up for it, go work at a post-Series B startup. But if you're up for it, steel yourself and make it happen.
And for the emerging managers on the call, this advice applies to you as well, because you're also a founder, except you're a founder of a venture capital firm, and it's going to be just as brutal for you as it is for everybody else, right? So just make sure that you embody these principles, because I do think they're very, very valuable. James, thank you so much for doing this with us. Epic, incredible. I learned so much from you, and thank you so much for joining us.
Thank you for having me, Mike. It's been great. Thank you.
Bye, everyone.
Thanks. Thank you so much, Mike. Thank you so much, James. I will let you log off. I'm going to move you from the stage. But yeah, awesome, everyone. Thank you. Thanks so much for our speakers, James and Mike. They did a great job of talking about this space. We're going to conclude now. Just there's going to be some networking opportunity. We still have 250 people live. Please network with each other, learn from each other. There's quite a bit of knowledge that's in the audience. Just as a closing note, we do have a few upcoming Venture Trailblazer events. We'll post it in the chat, fi.co/events. Go sign up for some more. If you've enjoyed this one, I've certainly had fun. We have a really good lineup. I'll put it up on stage. But thank you so much for taking the time. Please, we'll leave the tables out for the next few hours. Network away and just talk to one another about what you've learned, and we can go from there. Anyway, thanks. Thank you, everyone. We'll see you in the next Venture Trailblazers. Bye.